Welcome everybody. We're in sunny London at the moment. Thanks very much for tuning in to listen to our announcements of our first full year on the AIM stock market. We were listed on the stock market on November the 5th, 2021, and this is our first full year. So we're very pleased with our results. The market was very tough. It was backwards by about 10%. We finished just shy of 98 million. That was our revenue for the year ending 31st of March 2023. The growth was 21.5% over the previous year. Adjusted EBITDA was 7.5 million. Cash conversion was very good. We finished in a net cash position of 10 million. This is all driven from our next day delivery service and our installation service, which we'll talk about shortly. But we've got a 4.8 rating on Trustpilot, which I'm sure you're all well aware of, is a real benchmark in any industry now to give you a measure of your performance and your customer service. So that's market leading. We're very pleased with that 4.8 out of 5, and that's driven from the focus that we have on what we do, which is major domestic appliances and CE, consumer electronics, television mainly. That's a market we really want to grow in. So we've got 4,500 SKUs in stock, which is made up of over 35,000 actual items, actual boxes. We deliver to over 90% of the UK population, and that's next day delivery. And next day installation is over 65% of the UK population. We've shown there 250 odd employees. It's now actually about 270 employees now, and growing. It was about 150 at time of float.
Thanks, Mark. Moving to the market. So what we're showing here is a major domestic appliances market first, which is the major market in which we operate. You can see the full size of the market here in the small bars. So you can see it's gone down slightly from 4.5 billion to 4.2 billion. For the eagle-eyed of you out there, GfK actually changed some of the market stats this year. They moved floor care out of the MDA market and moved it into the small domestic appliances market. So our numbers are slightly adjusted versus the presentation of last year. And we finished the year with a 2.5% market share of MDA and then a 4.7% market share online. And you can see how we've moved from 3.5 to 4.7 because, as Mark mentioned, the online share contracted fairly sharply at the beginning of the year, but it's now relatively consistent at around kind of 53 to 56% of the overall market is the part that's online. In relation to consumer electronics, during the COVID year, a lot of people updated televisions when they had spare cash. That market has been under some pressure for a couple of years now, and we're gradually increasing our market share in this market, albeit the market share is still extremely small. So we've got 0.3% market share of consumer electronics overall and 0.6% market share of the online market. So lots to go after in that market.
This slide's quite an interesting one. We thought we'd put it in for thanks very much to those of you who have bought into our business. We really appreciate it. This shows at time of float, so November the 5th, 2021, we had a Trustpilot rating of 4.7, and you can see the dark blue shading is what we're currently at. So we were at 4.7, we're now at 4.8. We had 190 odd employees. We're now actually at 270 odd employees currently. Vehicles, we had 36 at time of float. We've now got 50. We were doing installation of built-in products. That's integrated appliances. We were doing that for a third party. We've now taken that in-house, and we have our own crews going out doing the full installation. They take the products out and do the installation at the same time. We'll talk more about that in a bit. Now, brand awareness has gone up from 6% to 15%. CRM database was about 100,000. It's doubled now to nearly 200,000. Daily website traffic was 15,000, and now it's 23,000 unique visitors per day. Cash position as well is pretty decent. Went up from 4 million to 10 million, so that's a decent gain. It's a good position to be in. And on the right-hand side, it shows a geographic coverage in the blue shaded area of where we do our next day delivery. where we were doing it. And well, sorry, next day we don't do the shading is quite correct on the bottom. Devon, Cornwall, and Scotland. That's a 48-hour delivery service, but that's next day delivery. All the remainder. Financial highlights. Josh,
I'll take the section. Okay, so talking through some of the really high-level financials, you can see on the right-hand side here, we've got the revenue development over the past few years. So when we floated, we just completed 56 million in the March. We floated in the November, so we were part way through that year when we finished 80 million. And as Mark mentioned, FY23 is our full year on the AIM stock market, and we've just achieved just shy of 98 million. Often asked the question whether we wanted to do 100 million. Of course we did. We would have really liked that, but we didn't want to sacrifice margin. And I think that's important here, that it's not revenue at all costs. You know, we really want to make a good margin, make sure that we're delivering good cash flow and keeping that customer service very high. So we finished the margin at 7.7%. I'll come on to that in a little bit more detail in the future slides. Cash conversion was very strong at 118% as we benefited from some working capital improvements, which I'll go through. Return on capital employed, 41%, down slightly year on year, but that's literally just as a result of holding a net cash balance. The cash is up year on year, so the ROCE has declined slightly. And our overheads, a key element for us is to really keep a tight control on overheads. We limited this to 6.7% of sales, despite some external cost headwinds that I'll talk to. And we'll be looking for lower than 6.7% of sales in the coming 12 months as we get some operating leverage on that overhead base. Go to the next one, please. So moving on to the P&L in a little bit more detail, you can see in FY22 how we delivered a 19.8% gross product margin. That is a gross margin that is the product margin itself, and then the logistics cost, and thirdly, any fees in relation to buy now, pay later, credit card, American Express charges, what we call the interchange charges. So that gross margin is a fully delivered margin to the customer. So the product less all the costs to actually get it to the customer, but doesn't include any overheads. So we saw a little bit of pressure there, 40 bips from 19.8 to 19.4. And that was primarily driven by logistics cost increases across the fleet. You know, there were some temporary measures. For example, fuel costs were up in the year. Obviously, they're coming back now. And national insurance was up temporarily as well. And we also had some pay rises. Advertising and marketing, we always said that we would spend about 5% of our sales as we're a growing business. And we kept that quite disciplined, went up in absolute terms by nearly £1 million, but we kept it disciplined at 5% of sales. The overheads, as mentioned, went from 5.8% to 6.7%. And as I mentioned on the previous slide, we'll be looking to reduce that 6.7% and head back towards 6% in the coming financial year, probably end up at something like 6.3, 6.4, but we will certainly try our best to get as much operating leverage as possible. We finished with adjusted earnings per share, slightly down versus the prior year at 4.82p. There's a little bit more depreciation as well as we've added additional vehicles and made some leasehold improvements to better the operation. But the positive thing here again is we've done a 20% dividend payout ratio, bringing the final dividend to 0.66p and the full year dividend to 0.96p, which would be paid in August, hopefully after approval at the AGM. Going into a little bit more detail on the margin bridge. So last year we did 9% adjusted EBITDA margin, and that's moved down to 7.7%. So to give you some flavour as to why, firstly, we had some logistics wage increases, making sure that our drivers are well paid. There was the temporary national insurance rate rise, which some of you may remember the employer paid 13.8. That increased to just over 15%. And then it's now come back down to 13.8%. So that shouldn't repeat in the next year. There were fuel cost increases during the year, but they've now stabilised and starting to come back down slightly. Fuel costs are just over 1% of sales, so it's not heavily significant. In the overhead base, we made some employee cost investment. We've got a true 24/7 distribution centre now. Our warehouse operates on a 24/7 shift pattern with 4 days on, 4 days off, 2 shifts, a night shift and a day shift. We didn't used to operate it like that. We kind of closed on a Sunday. So introducing that true 24/7 did have a one-off cost impact, but we will start to lap that next year. We've added some additional resources, particularly in our buying teams, just making sure that we're really building a quality base of employees across all the different elements of the business. And then finally, the PLC costs. So last year, we only had 5 months of PLC costs. This year, we had 12 months of PLC costs. These are not significant costs, but small costs associated with being a PLC, like listing fees, and various other costs. And again, as we move into FY24, we will lap this base effect as well, and we can try and drive some operating leverage off that. So looking for around 7.9 to 8% margin in FY24 with a bit of an incremental improvement. Moving to the cash bridge, so just putting it in a bridge to make it nice and clear. So we finished last year in the net cash position of 3.9 million. We had quite a strong cash flow from operating activities driven by the profitability as well as the working capital improvements. We paid dividends of 1 million, which is the final dividend of last year paid in August, as well as the interim dividend that was paid in December. We had CapEx of about 1 million, which was spent on vehicles. We're now buying a lot of our vehicles cash rather than leasing them because of the interest rates. And we also had some leasehold improvements, some racking, mezzanine floors that we'll talk about in a future slide. Lease liabilities is the rental cost for our existing property that we operate out of, as well as some vehicles that remain on a lease. And then you had tax payments taking us to our £10 million net cash position in March. The final section on the financial review is just a little bit more detail on the cash and working capital movements. So you will see in the top left there that we had a slight inflow from inventory as we reduced inventory from 14.4 million to 14.2 million. So just shy of 200k cash inflow from that. That was probably slightly better than we expected, which is good. Those of you that have followed us since the IPO will know that at the IPO, we had an inventory holding of about 90 days. Obviously, that's quite a high inventory holding, and we've managed to bring that down to about 70-ish days, and we're looking for incremental improvements thereafter. So quite a big movement in 1 year to go from working capital at 4.9% of sales to working capital at 1.7% of sales. And we do think there are incremental improvements from here, but probably not quite as large as that big jump from 4.9 to 1.7. The outflow from receivables primarily relates to year-end rebates that you receive from suppliers if you hit certain volume targets. So we usually collect those just after the year end. And then the increase in payables is led to improved supplier terms and credit lines with the credit insurers. And that enables us, obviously, to offset future increases in inventory too. So overall CapEx, as we mentioned, we spent around £1 million on CapEx, and that was 1.1% of sales. And we expect to spend around 1 to 1.1% of sales in FY23 with some of the developments that we've got planned. And we're also looking over the next 12 plus months to be introducing a new ERP system. We'll give detail more about that in our half-year presentation as we actually embark on that project. But we're looking at changing our ERP system from our legacy system, which is quite old now. It's called Everest, into a new ERP system using Microsoft Dynamics. So that's a kind of 1 and a bit year project. This current financial year, FY24, will be on the old legacy system. But then as we plan for the future and we want to facilitate our growth, we're going to put in place a new back-end ERP system really to support that growth in the future. Obviously, a very big project. We expect it will probably cost us in the range of about £3 million, but just something that we obviously want to flag as happening and us really investing in our growth.
Thanks, Josh. So that's the end of the financials for now. So the ME strategy, the Marks Electrical strategy, 4 key pillars within the business. So customer proposition is the first one, brand awareness, marketing, etc., operational capacity, that's of our current site, and then financial performance.
Sorry, this one?
Yeah, please, Josh.
So just to take you through how we distribute across the UK, because obviously it's quite an unusual map and there's lots of colours here. So first and foremost, the green area in the centre, obviously you can see the ME, which is where our distribution centre is based in Leicester. We run a fairly unique model because we only have one distribution centre and we go out from the distribution centre and back each day, apart from some of the extremities which we'll come to. So on the green area, the rectangle that you can see in the centre, that's 65% of the UK population. And that's where we do next day installation of built-in items. We'll explain that shortly, to that green rectangular area. So what that means, if you live on the south coast, say Folkestone, we wouldn't offer you installation at that point of a built-in item, but we could do installation of a freestanding item with our delivery team. So the core installation team just works within that green rectangular area. That's around 2 hours from the base. So it makes sure that the driving time works along with the installation time. The darker blue, as you go a little bit further, which is kind of, let's say, Newcastle in the top right, down to Exeter in the bottom left, that's where we will offer next day delivery. So we do next day delivery to those locations. We use a combination of vehicles. We use both 5-ton vehicles, 7.5-ton vehicles, as well as the 3.5-ton vehicles. And depending on the route time, depending on how far the driver has to go, based on driver regulations, obviously we aim to fulfill that entire area, but it all has to work, of course, from a driver timing perspective. The extremities, the light blue, so this is Glasgow, Edinburgh and Cornwall. We run these with C-class vehicles. So these vehicles, they, for example, in Glasgow, we go up on a Tuesday, we deliver in Glasgow later in the Tuesday, the guys stay the night. We have some very nice arrangements with a number of B&Bs that we work with. The guys really enjoy the trip. They then do Edinburgh on the Wednesday and then they come back down and that works very efficient for us. It's profitable and we actually get quite a lot of driver uptake for this. Again, that's completed in C-class vehicles where there's that bit more of driving time to do and it's all monitored and maintained that way. So this is how it works for us. I can imagine that in time we will be able to do more frequent deliveries to Cornwall, Glasgow and Edinburgh and probably go up there more frequently. But as things stand, we believe that this simple distribution model is the best way to maintain our profitability. And certainly in the coming years, we're not looking to add additional distribution centres across the UK. We just work within the areas that make sense for us from a profitability perspective.
Thanks, Josh. Yeah, so to discuss a bit more about our built-in installation service, here you can see on the slide. So yeah, like Josh was saying, the green rectangle, let's call it a rectangle in the middle of England. That's where we offer the installation of built-in products. So integrated fridge freezers, range cookers. It might be an induction range cooker, an induction hob, gas range cooker, gas ovens, etc., etc. So we do all the installation ourselves. We used to farm it out and sub it out to a third party. We brought it all in-house because you're always better to be in control of your own destiny. We found we got a lot of issues using a third party. So we now do it all ourselves. This works very well. And the way it works, it's exactly the same. The vehicles are loaded overnight. And the vans, smaller vans, you see that picture on the left-hand side, bottom left, is a Mercedes Sprinter panel van. These have got tail lifts on. Some of them have tail lifts for the range cooker installations, and those go out, leave in the morning, go out and do half a dozen installations, depending on whereabouts they are, obviously, and then they come back the same day hopefully with an empty van, except with the old products on and the old recycling material. So we do the whole thing. So it's not like a lot of services where some people might do a delivery of an item and then a fitter comes along and actually connects the gas cooker up. We turn up and do the installation in one go. which works exceptionally well. So we get very good feedback about this service. It works very well, and it's a real driving force behind the success of the business. Last year we had an attachment rate of about 2% to our sales, and this year it's about 8%. So we're seeing a lot more uptake on the installation. When people buying a built-in product, they really do. It's not as anybody apart from gas can do the installation of an integrated product, but it's a nice service to have. Rather than having to do it yourself, it's also have the actual option to be able to pay, £139 for an integrated dishwasher. Someone to come on and do the whole job, install the dishwasher, take the old packaging away, the old product away as well. So it's a one-stop shop. Next slide, please, Hannah.
Yeah, so in relation to SKU development, I think the first thing that's worth pointing out is we have a very small market share of major domestic appliances at 2.5% and consumer electronics TV at 0.3%. So firstly, we're not looking to see a mass expansion in our SKUs. We want to make sure that for each of the manufacturers, we're ranging all of the SKUs that make sense for them and make sense for our business model, and try and aim to have all of those SKUs in stock at all times if we can. Obviously, easier said than done, but that is our objective. So we're not looking to take this SKU count from 3,500, 4,000 SKUs to 20,000 SKUs. That's not our intention. We believe that we can really focus in on our core, which is delivering major domestic appliances and consumer electronics. So there'll be a bit of variability over time, but keeping to this type of range. On the right-hand side, you can see our improved penetration in finance. So we offer both buy now, pay later options with the likes of ClearPay, Klarna and PayPal Credit. And then we also offer the more traditional longer term retail financing offers, either interest bearing or interest free with the V12 retail finance offering. That's been improving gradually over time. My expectation is that it will probably plateau at about 17 to 20%. That's probably where we'll get to. So the overall share of basket of these products is probably going to be around 17 to 20%. I don't expect it to go much further than that.
Thanks, Josh. Next slide, please, Hannah. Yeah, you can see here we focus on premium products. So we're like a higher average order value. That's what we go after. I've built the business on selling premium product. So the likes of, Miele, LG, Samsung, Rangemaster, Bosch, Samsung, etc., AEG. We like to sell premium product. It's got a higher average order value. They're easy to install. They go wrong less. The instructions are a lot better. The packaging is generally better as well. So, you can't beat a higher average order value. So we really do aim for those products. We also sell, the entry-level products like your Beko and your Indesit as well. We don't want to ostracize ourselves from the lower end of the demographic. So we want to cater for everybody, but we predominantly focus on premium product. So that's that slide. Next slide, please, Hannah. This is an area that we're really investing in. We did a bit of a survey and we've realised that we were very, very good at logistics. We're doing very well at what we were doing, but we weren't very good at training. So we decided what we're going to do is improve our training. We're already, to get a score of 4.8 out of 5 on Trustpilot, you're doing something pretty good to be at that level. We decided to set up our academy, and that's within our current building. So everything, by the way, is under one roof. For those of you that don't know us very well, we've just got the one site on Boston Road in Leicester, and the IT team are there, the accounts team are there, Josh and myself are there, all the stock is there, all the lorries are there, the logistics are there, the data inputting team are there as well. So also we're going to have this academy there. So again, they'll all be under one roof. And because at the moment we've been sending guys out and training them out on the road, but you don't get the consistency of how you actually want to do installations and how you do the delivery without actually putting them through a proper classroom setting and showing them mocked up a house or an apartment. So when you come in, they're not actually going to park the vehicle outside. It will show them the attitude, how we expect them to talk to the consumer. Hello, Mrs. Smith, good morning, and kind of see where the appliance needs to go, and then we can view the route as you go in. And the trainers will show our guys exactly how we want them to wheel it into the house, over the threshold or up over doorsteps, for example, where to park the van, how to unpack the product properly in the consumer's house or outside if necessary, not to actually drag the cardboard down the walls of the newly decorated hallway, not to leave marks on the floor, and wear shoe protectors wherever required. Just to do a really good job of bringing the product in. An American fridge freezer, it's not an easy product. You got to take the doors off it, get the product inside, then you have to put the doors back on the product when you get it into the position where it's going, and then connect up the water supply. So it's quite a tricky job to do. We want to get consistency within our workforce of exactly what we expect from them when they're installing any product, or just a straightforward delivery. Whether it be, installing an integrated range cooker or dropping off a tumble dryer, we still want to get a consistency of delivery, a good quality, make it the best in class.
Next one. So moving to brand awareness, as Mark mentioned in one of the earlier slides at the float, we had a 6% brand awareness in the UK. We created our own study with YouGov. We asked a simple question at the beginning of the study: have you heard of Marks Electrical? And the response at the IPO was only 6% of people had heard of Marks Electrical. Rolling back 12 months, so this time last year, 7% of people had heard of us. And about 6 months ago, when we did the study for the half-year presentation, 10% of people had heard of us. So we've seen a good improvement in 6 months, from 10% to 15% overall in England. And the most marked improvement clearly is over there on the left-hand side in London, where we've moved it in 6 months from 12% to 22%. And a lot of that has been driven by our traditional out-of-home marketing across and around central London. So the tube network, on the rail network, telephone booths, roadside displays, these types of activities. So traditional, you could call it old school marketing, has actually paid off here. And what that's allowed us to do is to be a bit more flexible across our marketing budget. So there's lots of areas that we could still penetrate. You can see, for example, the Northwest, 10%, that's only moved a little bit. Yorkshire and the Humberside as well. So there's a lot of opportunity where we can still grow our brand awareness. But for now, our focus, given our location, is on the East Midlands and London. And London is the largest market for us on a daily basis, and it's where the majority of our sales are generated on a daily basis. The right-hand chart, this again, it's from our YouGov study, so it's not necessarily an accurate split of how the market is carved up, but it's probably a reasonable proxy for the market shares of the various different players. We ask people, where do they usually buy their major household electrical appliances from? So no surprise, Currys being the largest, along with the ones that you'll know well, being Argos, John Lewis, and AO. We often get asked, where do we think we're taking share from? And as we're very focused on the premium end, we believe it's probably John Lewis, and that's certainly something that we'll be focused on. But it's a huge market. There's lots of opportunity for a lot of players. But as we're focused at the premium end of the market, that's definitely our target. The 20% that says none of these, that's what that one is. That's likely to be the independents, so the smaller independents, of which there are still many across the country, doing an excellent job locally.
Thanks, Josh. So, how are we carrying out our growth? It's down to brand building. When we floated on November the 5th, 2021, we were floated and depicted by Pam Muir-Gordon as the UK's best kept secret. And it's all about changing that mindset and getting our name out there. And like Josh was just saying, the brand building is a key part of this business. So we're now in our third generation of TV advert, which we launched the beginning of this month. We've seen that sales are certainly very, very strong, which is great. I'm not saying it's just down to the TV advert, but we've got it's a really good advert. And we also do a lot through the tube, stations, airports, motorway service stations, we do this in conjunction with the manufacturers, you know, Hero in their actual brand name, and we work alongside them, creating the artwork, the imagery, and we take advantage of a lot of last minute offers on options on advertising. So on the right hand side, social media is an area we neglected it. To be perfectly honest, we didn't really think you went on social media to buy a washing machine. That was probably a bit of an old school thought. Now we've got a connection with a company who actually did Deliveroo and a few other big names as well. And then we've joined forces with them. And our social media is having a really big impact now. And that's working exceptionally well. Next one.
So moving to annual website traffic. So we've seen a good and steady improvement in our annual website traffic. I think if anything, you know, the eagle-eyed will notice that the growth in total orders is faster than the growth in total website traffic. So the quality of that traffic is improving and the conversion rate is improving too, which we're very, very focused on. You know, it is quite easy to get fairly poor quality traffic quite quickly, but that doesn't mean that that traffic is actually going to convert. So we're working with the various agencies we work on in terms of SEO, PPC, affiliate marketing, and obviously the direct marketing that we're doing too, to drive that web traffic and make sure it's web traffic that's going to convert. On the right-hand side, you can see the continual growth each month in our CRM database. We only had 100,000 people on our email database when we floated. We're now approaching, well, just over 200,000 people. We're quite disciplined in the way that we send our CRM. We generally only send one email per week. Often there will be a brand that will sponsor that email and we'll work with that brand to send that to the customers. And again, it's a nice way of marketing to their existing customer base, but not too frequently, so as they would unsubscribe. Returning customer growth. So we're around 25% returning customers, which again we're very happy with.
Thank you. So yeah, one of the other things is operational capacity. So we're continually looking to upgrade and improve and make the most of our warehouse space. So you can see that that's one of our warehouses. That's the smallest one. We've actually got 7 warehouses all connected together on one site. It's an 8-acre site at Boston Road, and this is the smallest one. There's about 1,000 ovens in there on that left-hand image. And then we decided we were going to put some nice racking in, some narrow aisle racking. And we now can fit in 2,500 ovens in that same space. So we are clearly using the airspace well with some narrow aisle forklifts, which all electric, all Lindy, all German built product. And they work very well. It's improved the picking massively, the speed in which you go and find the actual products. Before it was only quarterized in the warehouse, whereas now you've got 100 odd locations, so it's very easy to go exactly to the right place. You get less damages, easy to pick, easy for the actual operatives to actually go and find the products, and obviously increasing your space within your warehouse is that's what everybody's after, trying to maximise. So we've done that. Some mezzanine floors, we've put some more of those in. Some dock levelers are going in as well, and also improving the office space. We've managed to eke out some extra office space, which was before just some old rooms that we managed to knock through and improve the office space. So we're trying to stay there for as long as we can. We reckon we can exceed 250 million from this current site. We said at the float we thought we could get to 250 million, whereas now we feel comfortable that we can surpass that, but we want to be looking at moving before we actually get to that figure. But that's the aim. We want to keep improving our market share, in a market that's still going backwards. Here we are making great inroads with our revenue development. Vehicles as well, by the way, we've got currently 50, and we've actually got 35 on order now. So we're improving the size of the fleet, and we have different size vehicles for different areas. So a bit like, British Airways, for example, they have different size planes for different size routes. And we do exactly the same way. We get a big density of delivery. We do have larger trucks.
Thanks, Mark.
Thank you.
Yeah. So just to finish this section, the 4th pillar of our strategy is to make sure that we're delivering financially. Most of these stats we've already taken you through. The average revenue per employee, so that went down slightly in the year. The 429,000 would have been probably more like 470,000 if we exclude the installation business, because of course we've brought that outsourced offering is now in-house, so that comes with headcount. But we're very keen over the next 12 months to aim to keep that average revenue per employee, above £400,000. It's a key metric we look at to think about when it comes to productivity. Dividend over on the right-hand side, as mentioned, we paid a final dividend of 0.67p last year. This year, the full year dividend to shareholders is going to be 0.96p, and we're proud that as a newly floated AIM-listed business that's growing, that we've been able to pay a dividend for holders for the past couple of years. Good improvements on the working capital, as previously mentioned, which has therefore led to a really nice free cash flow margin at 7.3%. And generating good quality cash is something that we're very focused on. It's revenue growth, absolutely, but not at all costs. We want good profitability and a nice healthy return in cash. Got 10 million of net cash. We expect to finish next year a little bit ahead of that, but obviously we've got some cost outflows with additional capex, as well as the ERP project that I mentioned. That being said, we hope to improve net cash a little bit year on year. That's now earning us a little bit of finance interest, which is nice to see. And we want to build up a cash pile over a period of time so that when we do need to do that warehouse move one day down the road, we've got plenty of firepower to help us move warehouses, do some leasehold improvements, and then thereafter we can think about our capital allocation policy in the future. But that's a nice problem to have in the future.
Thanks, Josh. Pardon me. So yeah, so outlook for this current year. So we've had a great start to the year already. Last year was quite a slow start to the year, so the comps are quite easy to beat, but we're 30% up in April and in May, and then we've improved on that through June, which is great. So even though there's a lot of talk about the consumer living crisis, things are tough and retail is difficult, we're still managing to make taking market share, which is what we're after. Well, one thing to remember here is that it's a huge market. The TV market and the MDA market combined is nigh on 8 billion. We're only we've only just finished shy of 100 million. So we've got a minute market share of a huge market, and we are in the business of selling products with distressed product. I think about 80% of our sales, something like that, are distressed purchases where people, the washing machine's gone wrong and you need a new washing machine, or your fridge freezer, you need a new one. It's not a considered purchase. A television is a considered purchase, but that is an area that we really want to push and drive into, because currently we've got a minute market share. I think it's 0.3%. So it's minute, but it's an area that we really are going to drive into. We've got great connections with the likes of LG, Samsung already, Hisense, and we really want to push into that space. So that's a summary, and we welcome questions.
Your main bricks and clicks competitor appears to be continuing to push for volumes. On the other side, your main online-only competitor was forced to seek higher margins, but may now have a new source of funding. How do you see the competitive situation developing in full year 24?
You know what? I've been in business 36 years, Hannah, and the landscape is changing. There's always an acquisition or a merger, a couple every year. You always get something. We just concentrate on what we're doing, which is building the business and delivering a return for our investors, our shareholders. It's always easy to keep looking over and seeing what everyone else is doing. You need to be aware of the competition, but you just concentrate on, driving your own business forwards. That's what we always will do, and concentrate on margin, increasing revenue, improving the slickness of our operation, and that's the focus.
Thank you. You alluded to this just in your commentary, in your summary comments, but what's the revenue capacity of your current business, and how much can you grow before you have to spend more in growth capex? 250
million we can get out of this current site. And the capex is only like 1% of revenue anyway. And we're really, once we put the racking in, once we put the mezzanine floors in, which are all virtually in already, you won't be able to spend any more on that, and the dock levelers that are going in. So once we've spent that, that's about it. And vans we've been paying cash for as well. the vehicles will always be on the CapEx, but so part of the ERP system. Josh, do you want to?
Yeah, no, I think no, as you've said, I think 250 million from the current site. Obviously, we've got ambitions to, get there faster than the forecast suggest, and then we'll move to another site, and obviously that will be an incremental step change. But from the current site, we're pretty comfortable for the next few financial years that we can stay where we are without significant capex.
Question here: how much will the new warehouse cost? Would you like to hazard some thoughts?
We wouldn't buy it. A new warehouse, it's about £8 a square foot in Leicestershire. There's one very close to where we are, so it's 600,000 square feet. So you can do the maths there. But we wouldn't be buying it. It would be on a leasehold, and by then we'll have built quite a nice cash reserve. So it will be a major problem moving to a new site. You're going to need a bit of a cash pot to for leasehold improvements, etc. But we wouldn't need to go and fill it with a load of stock instantly. We wouldn't need to go and buy a load of new vehicles or a load of new forklifts, because we'll have all those already. The IT system, we want to put that in, the new software in place before we move. So that's why I want to crack on with that. We don't want to be in the situation where we're moving and putting in new software at the same time.
Double header, yes, perhaps not. Roughly what percentage of your current revenue is next day delivery?
I would say it's probably about, at a guess, probably about 60%. We don't actually monitor that super closely on what is next day, but I can look at the numbers and say about 60% of what we sell is dropping into the next day. Of course, a sale that we make right now for a customer, they might choose to book it in on a Friday. They might choose to book it in next Friday. That's really up to them. Interestingly, our busiest day for deliveries in a week is a Friday. Didn't used to be the weekend, but now it's a Friday because a lot of people work from home on Fridays nowadays. So a lot of people book their deliveries in on a Friday.
Good. Why is awareness in the Southeast so much lower than in London specifically? And do you see scope for the Southeast catching up so that you can create a super trading area?
Yeah, look, it's a really good question. I think as we continue to do the marketing in central London, we will see a gradual improvement in the Southeast. We don't do any specific campaigns in Southeast catchment areas. So, for example, we're not doing specific billboards in Tunbridge Wells, or in Folkestone or locations like this. We may move to that in the future, but at the moment we're really focused in on central London and some of the train lines around central London, and we'll hopefully pick up some of that passing Southeast trade over time. So I think it will build over time. Interestingly, the market share in the Southeast is not aligned at the moment with the growth that we're seeing in the Southeast. So we're seeing growth in the Southeast that is quite similar to the growth that we're seeing in London, which is faster than the overall group growth. But the market share is still a bit softer there. So we'll see how that develops over time.
Perhaps one for you, Josh. I saw that there were fair value gains of 481,000 versus 195 last year, which helped to boost profits. I'm not sure what this relates to. Can you explain?
And indeed, yeah. So we are probably one of the very few companies on the market that has a statutory EPS that's higher than its adjusted EPS. Try and find one of those. And the reason for that is because we have a share in the buying group. So we're part of the Euronics buying group. Euronics buying group is the biggest buying group in the UK. Euronics is one of the it's the biggest buying group in the whole of Europe and one of the biggest in the world. There are benefits of scale of being part of a buying group, and we have a kind of cooperative share in that buying group. And because of the timing of our different financial year ends, we decided at IPO that we would keep this item separate and we wouldn't include it in our adjusted trading profits because it was quite difficult to forecast the performance of the buying group. Obviously, we're not in the management of the buying group, nor are we in the board. So we don't know how the buying group is performing at the top level, and their accounts close after our accounts close. So this fair value gain relates to our share of the buying group, which basically sits as an investment on the balance sheet. So you will see an investment line on the balance sheet. That is our investment in the buying group. We are one of the largest members of the buying group. And if we were to ever leave, which is not something we're looking to do, but if we were to ever leave, then that investment would basically turn into cash. So it would get liquidated into cash, and then that fair value difference would move away.
Thank you. A couple of questions here on what you're defining as the premium segment.
Yeah.
The first one is, what market share do you have of the premium market you target? And then the second one is roughly how big is that portion of the overall electrics market?
Yeah.
It's a good question, and we don't have precise stats on it because it's quite difficult to disaggregate some of that information, and also our definition of premium could always be different to somebody else's. When we define premium, we're looking at things like Bosch, Neff, Siemens, LG, Samsung, Rangemaster, Miele, Fisher Paykel. These are brands that we would consider to be premium. There are a whole host of other brands which we work with, like Hotpoint, Whirlpool, Beko, Indesit, and we don't not serve those brands and customers. We offer the whole range, but we have always, the business for 36 years has always had a focus on premium. It'll depend by brand. Some of the brands we have higher penetration. So if you take Rangemaster, for example, we are one of the biggest partners with Rangemaster in the UK, and our market share of Rangemaster, which is a very premium range cooker, is much higher than our 2.5% market share of the overall MDA. But it's difficult to give a figure just generically on premium in the UK, but you can see it's higher than the 2.5% that we have of the overall market.
Okay, and are there any MDA or CE brands which you would consider to be too upmarket for your offering?
Yeah, things like Gaggenau, Wolf, Viking, a lot of the big American brands. I mean, there's not enough volume there for us to bother going after it.
Okay, thanks.
We don't neglect the entry-level brands. We still do a lot of business with them, but we always want to try and sell premium, as does any business. There's more profit in selling premium product. You would far sooner deliver £1,000 Miele washing machine than a £200 Beko washing machine. You might get the same 30% margin on either, but clearly there's a big advantage selling the £1,000.
Absolutely. Do you earn revenue from the MDA you collect from customers?
Yeah, we do. Not a huge amount, but it's we're going to make it. There's an upside, £20 for taking away the old product. That's including VAT. And then we get an upside for selling it as well. And it's a great service, and it all gets dealt with through the WE directive.
Thank you. ERP upgrades can be disruptive. I'm sure plenty of investors on here have had experience of that.
Yeah.
What robust plans can you put in place to limit this potential disruption?
Good question. So I think I would start with, obviously, there's not a lot of businesses who would want to do an ERP upgrade, but if you want to plan for the future, you have to do it now. You don't want to get to 300 to 400 million and then realise that you've run out of road with your existing system. So it's one of those difficult decisions you have to make to put yourself on the path to change the ERP. The one real positive here is there's a massive willingness inside the organisation. We have 8 developers, real coders in our business. And all of our IT team are really keen for us to move on to the next platform. And I think that's always one of those stumbling blocks that companies have when the management team say, let's put in a new ERP, and they face quite a lot of pushback internally where people don't actually want to put the effort in to move to the new ERP, and that can be really disruptive. So I think the first point is we have a huge amount of willingness in the organisation because the team have worked with this platform for about 20 years and they really want to move on to a new platform that's a bit more fit for purpose. So that's probably the most robust thing that we have. We're working with a well-experienced partner. We've been beauty parading for about 6 to 12 months now. We considered doing this 12 months ago, but because of the cost of living crisis and we didn't know how the market would play out, we decided to just preserve cash, and hence we've built our cash pile of 10 million. So we've been looking at a variety of providers over about 12 months, and we've settled on one main provider, which is probably going to be KPMG. And we're quite happy with the creds and the stats and the work that they do directly with Microsoft. So hopefully a good implementation partner. We're putting some extra resource into it internally, and we've got a strong willingness across the teams.
And it's a pretty vanilla system that we're buying, isn't it, Josh? So you've not got multi-currency, you've not got multi-site either, or not separate P&Ls. So it's quite a straightforward software system that we'll be implementing.
Yeah, it's quite a simple, P&L from an investor's perspective. It's a simple P&L. There's no intercompany. We don't run consolidation. So all of those pitfalls are very difficult from an ERP perspective. They don't exist.
How are inflation and supply chain issues affecting Marks?
Well, I mean, there have been, it's been a bit of a rocky road, but you've just got to navigate the waters, haven't you? That's what you have to do. There has been inflation, clearly. The cost of containers, I mean, they went up to $20,000 from China to the UK. Now they're back down at a more realistic, the pre-COVID levels, $2,500. So manufacturers have tried to hang on to that margin, though, wherever they can, for obvious reasons. But it's always great when that's a great thing with dealing with lots of different brands. You can work out the price, what it should be, and play them off against each other to keep the price lower. So things have gone up, but not massively gone up. And the ease of getting stock, there's not really a problem with anybody now as such. The component issues have just about ceased. The supply of component issues is about ceased. So it's pretty easy to get hold of stock.
Okay, rolling a couple of questions here, basically around operational gearing.
Yeah.
The rollout of the built-in installation offering obviously brings extra costs, but you'd assume extra business as well. You've got more trucks on order and drivers. So
Yeah.
Can you give us a sense of how your revenues are going to increase and the costs, and how it won't be linear, I guess?
Okay, yeah, good question. So, I mean, firstly, I'll take the vans first. So adding an additional 35 vehicles, that doesn't mean we're going to go from 50 to 85. What we'll probably do is go through a bit of a replacement cycle. So we'll have some vehicles that are becoming over 3 years old, and we will replace out some of the older ones with the newer ones and probably settle at a fleet that's bigger than 50, but lower than 85. We're not sure exactly where that will land. We generally have a little bit more than the needed capacity on a daily basis, because what that allows us to do is, if there is a strong surge in sales over a weekend, or a strong surge in sales, for example, today, then we can actually put extra vans on to run that capacity tomorrow. We don't have to say no to those sales for tomorrow. We can drive that extra capacity. So it's always nice to run with a few spare vans, and of course, for those that are off the road as well. From an operational gearing perspective, quite a few of the costs that I mentioned in the financial section are baked in now. So the PLC costs, we had reintroduction of business rates after the business rates relief. We implemented the 24/7 shift change in the warehouse. So those costs are baked in now, and we can actually start driving some operational gearing on the overhead base as we move into the future years. And the bigger we get, the smaller that overheads can be as a percentage of sales.
Okay, thank you. I think the final question then, and there's a couple left, all relate to valuation. Obviously, do you want to give some views on your position on the valuation of the shares? We obviously know where the market is at the moment, but also how your large shareholding, Mark, might put some people off. You're a single shareholder. You could potentially take the business private again if the price got low enough. So would you consider reducing your holding? What comfort can you provide?
Yeah, I mean, I've come to market for a reason. I came to build the business and grow it. We've doubled it effectively in the last couple of years, and that's what we want to keep on doing. I'm fully aware I need to sell a bit more. When I came to market, I thought, I'll just sell 25%, wait for it to grow, wait for the share price to grow, then I'll keep selling another few percent. But obviously the markets went backwards considerably. We've delivered what we said we'd deliver. We've actually over delivered. But that's just how things go. And I realised that I need to sell some stock, but I'm not going to sell below float price. It's not fair on the existing shareholders, and I'll wait till we get past float price, and I'll start releasing a little bit more into the market and give it some liquidity. And I know I need to do it, and that is my intention. There's no devious plans here. You're recording it, so I'll sign anything you want. It's all about just being upfront with everybody, treat people the way you wish to be treated, and drive the business, get your investors, your shareholders a return, which will happen. So we want to make sure that everyone that bought in at £1.10 will make a profit. And there's not many IPOs that can say that from the class of 2021. So we will make sure that we get past that and keep driving it. We've got a great team of people. I could get run over by a bus tomorrow, and Josh and the team would just carry on and probably do a better job. I've not got a massive input, but the guys are great, very professional, and we know I need to sell some shares, so it will be happening, but not until we get past float price.
Thank you. Follow-up question here, or a further question. When delivering to the further out areas, i.e. Scotland and Cornwall, what would a driver's day look like? Perhaps somebody looking for a job. From pickup to return overnight stay.
Interesting question.
Yeah.
So I mean, all of our vans leave the depot at similar time in the morning, which can range anywhere between 4 a.m. 6 a.m. depending on the type of route. Those further out locations are C-class drivers, so they've got the CPC license. They're on a bigger vehicle, either a 7.5 or a 5-ton vehicle, which is on an operator's license. So it can be a longer day. Those days can go for up to 21 hours, but generally it wouldn't be as long as 21 hours. It's only 5 hours actually from Leicester to Glasgow, and it's 5 hours from Leicester to Penzance. So we really are kind of equidistant, centre of the universe, as Mark likes to call it. I'm not from Leicester, so I'm not sure I call it the centre of the universe. But
Bolton, lad.
Yeah, exactly. But basically, they will make their way up there. Generally, they'll head straight up there. Then they'll do some drops that time will allow within the Glasgow area. Make sure that works, and then arrive at their hotel in the evening. Usually, it's late afternoon into early evening. So that they're within hours, then get a good break overnight. They get really well looked after by the hosts that we've got in the few B&Bs that we operate with, because we're consistently booking these every single week. So the hosts really like us and like our business. They get looked after in the morning, and then they'll do some drops in Edinburgh, and then they'll make their way back down, and they'll be back at base at a sensible time. So it's a very favoured run by the drivers, because they get an overnight allowance as well as staying the night. They're usually with their friend in the cab. They generally like it because there's less traffic than London.
Sounds like a good deal. A final question, given time as well. Perhaps a wrap-up comment. What are your medium-term growth ambitions?
Medium term, just to keep pushing the business. We're at 30% growth year on year at the moment, and we just want to keep driving, but not at sacrificing margin. That is the key. It'd be great to double the business overnight, but we don't. You've got to actually deliver the product. So it's operationally taking the order is one thing, but you've actually got to then go and do the delivery. But the plans are to get to that 250 million and then push on to 500 million. It'd be nice to get a good share of the market. It's a huge market. There's plenty of room for everyone, and we see ourselves as a strong emerging player with a great proposition. One of the best offerings in the industry. Been able to do installation of a built-in product, tomorrow in London, if you order it now, with an integrated dishwasher, which there's not many companies out there that can do that.
Go off and buy yourself an aircon unit, everyone. Excellent. Well, listen, thank you both for your time this afternoon, and we look forward to an update in 6 months' time.
Thank you very much, Hannah. Thanks for listening, everybody.
Thank you, everybody.